guys, Josh Perez, the Synergy Mortgage Group, and just want to chat a little bit about interest rates. And we have a lot of clients who are reaching out to us wondering if we should really be considering transitioning our variable rate mortgage to a fixed rate mortgage, or otherwise known as locking in. So one thing around locking in that I think is very, very important to keep in mind is the perception around locking in is often brought forth with safety and security around a mortgage. And I really, really think we need to shift our mentality to considering more like locking into handcuffs, actually, because when you lock into a fixed rate, there's a lot of flexibility that gets reduced in your mortgage and the ability to access equity potentially. And so, when considering moving from a variable rate or a fixed rate, you got to look at a few different things, right? Your own goals with regard to, your property and what you plan to do with it, potentially moving, accessing equity, renovating, things like that. Also, where the spread is right now to lock in, right? So we have a lot of clients right now who are sitting in variable rates that are somewhere between, 1.25% and potentially like 1.5%. So very, very low interest rates. Right now, for most lenders, if you do lock into a fixed rate, you're going to be increasing your rate by 1.25 to 1.5%. So we're seeing fixed rates right now in the high 2% range. So by locking in, you're knowingly taking a higher interest rate, paying a higher payment, and moving on from that lower interest rate. So why would someone want to do that? Well, there's the perception that interest rates are going to be rising, and they very well may. But in order to actually be losing, if you were to flip from a variable rate to a fixed rate, interest rates would actually have to increase for those same clients where we see most people with their variable rates, somewhere between 5 to 7 increases before you actually start losing money. Because when the variable rate catches up, it's only at the point in which the rate surpasses what you could have had where you start losing money compared to what you had. So you have to see, A, is that even going to happen? And B, how far into the future or that term is that actually going to be? One thing you really need to consider when evaluating if it makes sense to lock in or transition from a variable fixed rate is the spread between the interest rates. So, what do you have currently today versus what you can get by locking in? So what we're seeing typically right now are clients that are sitting in some amazing rates that they'll probably never see again, 1.25%, 1.5%. And if they were to lock into a fixed rate, they would be jumping up considerably to, somewhere in the high 2s, 2.7, 2.8, 2.9%. So by doing so, you'd be knowingly locking into an interest rate that's, 1.25 to 1.5% higher than what you have today, because you think that interest rates are going to rise so high that they surpass that high 2%, right? So in order for that to happen, interest rates would have to rise somewhere between 5 to 7 times before that would actually happen, right? In the last 12 years, that's actually never happened. They've never risen that frequently. So for rates to actually rise that much and that frequently, I personally just feel it's extremely unrealistic. And the reason why fixed rates have often always been set as kind of like the benchmark of safety or the standard mortgage product is really interesting, just because historically the variable rate mortgage has almost on every 5-year rolling period over the last 40 years has almost every single time outperformed the fixed rate. But for whatever reason, the optics around fixed rate and security seem to always be encouraged or pushed. And I think the reason for that is that, almost every lender is thrilled to have clients position themselves in a fixed rate mortgage. And the reason for that is that locking in or that handcuff.